Alright everyone, my name is Winfried Heinrichson and I'm a lecturer at CBS International Business School in the beautiful city of Cologne in Germany. Today it's about accounts in financial accounting. So we'll have to talk about what accounts are and how they work, how you get your head around the debit and credit thing in financial accounting, and we'll also make a quick snack of what accountants call a general ledger and a journal ledger. Before we start, let me say that I will assume that you have some basic understanding of a balance sheet. If you don't, it might be a good idea to check out my introductory videos on financial statements. Links are in the description. So let's begin. What we call an account is, conceptually, nothing more than a mini clone of a balance sheet. So we make little copies of the balance sheet, and we do so for every single item in the balance sheet, from the left and the right side of the balance sheet. In the picture we see only 4 asset accounts and 3 liability accounts and 1 equity account. But that is because the space on the screen is limited. In reality, there are many more accounts. So why do accountants use accounts? Now, every business transaction has an effect on the balance sheet. So theoretically, what we see in the balance sheet would change every time a business transaction occurs. But the idea to update a balance sheet after every business transaction is a nightmare of monumental proportions. And not only that, but it's also quite impossible. Each of these accounts, the little balance sheet clones, will carry the data of the business transactions during the period, until that data will be put together again to become a balance sheet and an income statement and all the other financial statements. Each of these little balance sheet clones have a left side and a right side. In a textbook, an account often looks like a capital letter T. That's why we call them T accounts. Now, for making things easier, we give the left side and the right side their own names, and we call them debit and credit. Do not waste your time contemplating too long about the deeper meaning of debit and credit. For all intents and purposes, it means left side and right side of an account. One side of an account shows the beginning balance plus the increases or inflows, and the other side shows the ending balance plus the outflows or decreases. The logic of this is very simple. Let's look at the raw material stock in a manufacturing company. As you know, accounting is always about periods. So let's assume that at the beginning of the period, at the business year, the company may have $1,000 worth of raw material in their warehouse. Then, let's say that during the whole business year, they purchased $5,800 worth of raw material, which of course is an increase in the inventory. And also during the business year, they may have used up in production or otherwise $3,600 worth of materials, which naturally represents a decrease of inventories. Simple algebra will tell us that the ending balance is obviously 3,200. What we see here is the most important equation in accounting. Beginning balance plus inflows minus outflows must be ending balance. Now that's an equation, obviously. Now let's modify it by bringing the variable out for outflow to the other side of the equation. So we'll get beginning balance plus inflows must equal ending balance plus outflow. Each account, each T account, reflects exactly this equation, because on one side of the account we have beginning balance plus inflows, and on the other side of the accounts we have the ending balance plus the outflows. And that goes for all the accounts coming from the items in the balance sheet, left side or right side of the balance sheet, doesn't matter. But the accounts look a little different depending on from which side of the balance sheet they are created. Accounts coming from the asset side of the balance sheet have the beginning balance and the inflows on the debit side of the account, and the ending balance and the outflows on the credit side of the accounts. Accounts coming from the right side of the balance sheet have the beginning balance plus the inflows on the credit side of the account, and the ending balance and the outflows on the debit side of the account. As you can see, they have the same kind of data, but they have it on different sides. They both have the beginning balance on that side where those positions are located in the balance sheet, and consequently the ending balance plus the outflows on the respective other side. This makes it so important that you are familiar with the balance sheet items and where to find them, on which side they are to be found. Let's look at our inventory example from before. The beginning balance from the start of the period was 1,000. The increases during the year were 5,800. These are the purchases, whatever was purchased during the year and delivered to the company. And then we have the consumption of those inventories, and that decreases. That's the outflow from the inventory for the raw materials. That was 3,600. We can now simply calculate the missing variable. In this case, this would be the ending balance with 3,200. Now both sides of the account are equal. The collection of all these T accounts in a company is known as a general ledger. The general ledger is the core of any accounting system which holds the financial data of an organization. In addition to the general ledger, the accountant records every business transaction in what we call a journal ledger. In such a journal ledger, each transaction is recorded sequentially by date. It is recorded in a short, standardized form, so that anybody with some knowledge in accounting understands it and can work with it if necessary. The system is pretty smart because every conceivable business transaction can always be described by at least one debit entry and at least one credit entry. So each business transaction creates at least two entries, at least one debit entry and at least one credit entry. And it's even better. The sum of all the debit entries and the sum of all the credit entries must always be equal. If they are not, you can be absolutely sure something is wrong. For us learners, the journal entry consists of the date of the transaction, the accounts which are involved, typically with a unique numerical identification code. We come to that later. Then the debit entry or entries and the credit entry or entries. I say for us learners because in real life there's some more information and data involved, but for now it's good enough. Let's sum up real quick what we heard until now. First, the period, typically a business year, starts with the balance sheet and ends with the balance sheet. Second, for everything that happens during the business year, we need accounts to record what has happened to the balance sheet and actually also to the income statement. We come to that later. The accounts are little clones of the balance sheet and record the beginning balance, the ending balance, the increases and the decreases to that account during the period. Depending on from which side of the balance sheet the accounts originate, they have the beginning balance and inflows and ending balance and outflows on different sides. A journal ledger is like a diary of business transactions, which are described in a standardized way so that every knowledgeable person understands the information content. Number 2 and number 3 tell us something else. The business transactions are recorded in 2 sets of data, in the general ledger, which are the T accounts, and the journal ledger, which is the diary. The T accounts collect the information from a systematic standpoint. So if we are interested to see what happens with our liabilities, with the PPE, the inventories, the receivables, we can look into the T accounts and we find the information we need. But if we are interested in a business transaction that happened on a specific day or at any specific time, we need to look into the journal ledger. So that's it for now. Thank you for watching. If you want me to explain anything, just write something in the comments. I'll be happy to answer if I can.